Howdy, Jacob here. Today we're looking at TopBuild. It is in the household durables industry, 12.1 billion market cap on 12.5 billion enterprise value. Very good return on invested capital recently. We're seeing low double digits in the mid-teens and gross margin up, operating margin up, so much so that operating margin is just 5% lower than what their gross margin was 10 years ago. So very impressive feat there. They corporate in 2015, and yet they have data prior, so that's not right. Balance sheet shows 849 million cash on hand with 47 million short-term debt, 1.4 billion long-term debt. So let's see what that is in relation to cash flow. 1.4 billion in most recent year. That's just about 2 years. But even on a 5-year average basis, maybe 3.5, 4 years, we're really not concerned about that debt, especially with their hefty increase of free cash flow recently. If they can really keep a hold of that, then I think that debt figure is absolutely not a concern whatsoever. So this going into debt, 786 million for this acquisition. It looks right now to be a good price for it, as their free cash flow went up 300 million, so almost a fourth, essentially a fourth of what they acquired the business for. Increase their business. So it could be some organic growth as well, but for what I'm seeing initially, some pretty solid return there. Their use of cash historically, if we're looking at the last 10 years, heaviest on the acquisition side, and then a little bit of share repurchases. They do not pay a dividend at all. And so it's really just those two. There's not a whole lot of reinvestment. The capex is going up, but it's likely due to acquisitions rather than reinvesting. And so when we make our assumptions on capital allocation, we're going to have to balance out acquisitions with share repurchases, and then understand that maybe 5% goes to debt, 10% goes to debt, because they're likely going to be making acquisitions in the future, and they're going to find a $1 billion opportunity that they don't necessarily have the cash for to outright buy it out. So they might have to go into debt a little bit for it, but let's make some assumptions here. On the revenue growth side, I think they'll pretty much grow organically with inflation, and then acquisitions will go on top of that. So let's say roughly 6%. And then let's throw in essentially a market average PE, price to free cash flow. For margins, they have been higher recently. So maybe let's weight that more so on the more recent side. Let's do maybe 10, 11, with share repurchases of 1% would be about 125 million, 140 million to offset stock-based compensation, and yet they haven't bought back anything recently. So I'll just say they keep it relatively flat. And this is saying that almost all their money is just going towards acquiring businesses, reinvesting, getting this type of rate of return and these types of margins. And we're still saying that the company's stock price needs to fall 6-3% before you get to the return we're looking for here. So to me, it does feel a little frothy, but I mean, from a numbers perspective, I think I love the business and I would want to own it. But to me, they're at the highest margins they've ever been. I'm always skeptical that they'll be able to keep that going forward, or whether they'll fall back down to their averages. And for right now, I think it's just not obviously cheap for me, so I'm just going to wait. Hopefully, you enjoy the video and have a great day. Thank you.